Hi, everyone. I just wrapped up a great conversation with Jared Dillian, only to realize that even though we were seeing and hearing each other fine, the audio issues we are experiencing live also occurred on the tape versions. So much for pushing through. It wasn't anything we could control. It was some kind of bug with the platform. We got a notification about it, and they're working on it now. But unfortunately, there's nothing we can do. So apologies in advance. It's a little choppy. You'll see. You can push through. It's so worth it, as it always is with Jared. He talks about what's on his portfolio, but also there will be a full write-up and clips available on our Substack tomorrow. So if you can't deal with it, go there, check it out. The link is in the description, and you should be following us and subscribing there anyway, because we have a lot of really cool stuff we're working on that's going to be coming out over there. So go ahead and do that. In the meantime, thanks again for understanding what's fueling the U.S. equity rally. Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Jared Dillian, editor of the Daily Dirtnap and author of the new book, Rule 62, Meditations on Success and Spirituality. Hey, Jared, congrats on the latest book.
Thank you. Appreciate it.
It's out there in the wild. I'm super excited to talk about it. Yep, there it is. And I know you're going around doing book tours and all that good stuff. We're going to talk about that in a little bit. But first, really kind of interesting action today. We see stocks continue to defy gravity. All the major averages up, with some of those Mag 7 names, which everybody loved to hate, leading the way. NVIDIA reaching a $4 trillion market cap, first time ever for a company. Bitcoin rallied at the close and jumped to what looks like an all-time high there. All while President Trump continues to fire off tariff letters. What do you make of this, what appears to be this risk on market action?
I am bored.
Are you bored as you're counting money, or are you just
I'm doing okay this month, but like, I mean, the stock market is interesting. NVIDIA is interesting, hitting 4 trillion. The big beautiful bill is interesting, but in macro land, there's really not a lot going on. Bonds are in a range. The dollar is a little bit off the lows. I mean, I think let's just step back a little bit and talk about the big beautiful bill. I was having a discussion today with one of my subscribers, pretty smart guy, and basically this CBO is scoring this bill with an assumption that we're going to have 1.8% GDP for the next 10 years, which is pretty conservative, right? So on a static basis, like if you look at the big beautiful bill, it increases the deficit by trillions and trillions. But you know, honestly, if growth comes in a little higher, if we get like 2.5% growth instead of 1.8% growth, then that is going to make up. That's going to make up a lot of revenue. Also, the tariff revenue isn't really being counted. So if you price in a couple $100 billion in tariff revenue a year. So actually, I kind of changed my mind on this, because I was kind of like writing this macro doom stuff about how, you know, they're going to blow out the deficit. We're going to have 7% deficit to GDP, and everything's going to be terrible, and gold's going to rip. But I guess there is a possibility that it might not be as bad as we anticipate. It could be a little bit better. So
that's a really interesting comment. By the way, I just want to say hi to everybody who is joining us live on Substack and on YouTube. And the middle of the week, there must just be good vibes going around, because Paul just said, hi, all you beautiful people. And Russell is saying Jay's hair continues to be glorious. So everyone is in a very complimentary good mood, and I like to see that. So welcome. As always, put any questions you have in the chat. We'll get to as many as we can. And it's really interesting that you say that. By the way, read them all, and we appreciate them, and we'll bring them up and pose them to our guests, which is what I'm just about to do. It's interesting that you're kind of shifting and thinking about that, you know, bias and narrative sometimes. But Russell left a comment on my Substack today or yesterday. Thank you, Russell. Which I think speaks to what you just mentioned. And he was responding to somebody else that was on and said he's really skeptical of all those doomer and gloomers warning about trouble in the economy, in the markets. And he said, you know, $100 say they were all probably short Liberation Day and have gotten steamrolled. Why are you rethinking that this maybe isn't as bad as it might, or it seemed like it might be? Why are you kind of thinking?
I mean, basically, if the BBB was as terrible as people thought it was, then the bond market should be melting down. Gold should be rallying. Stocks should be going down. And you're not seeing that kind of price action. So then you kind of have to examine your priors and say, okay, like, if I'm not getting the price action that I expect, then maybe my interpretation of these events is incorrect. Right.
Mm.
So, I mean, I tend to be a pessimist about a lot of things in macro and in the markets. I tend to think the worst possible thing is going to happen all the time. But 1.8% GDP growth over the next 10 years is a very conservative estimate. I mean, we could exceed that by a lot. Now, that's not going to take the deficit down to 3% of GDP. It's going to take it down to like 5% of GDP, which is still high. But it's not to the point where the U.S. gets a margin call and rates explode to 7%, and it's terrible.
So the concept, and by the way, this is exactly what Trump and the administration is hoping for, and is what they're saying is that we're going to grow our way out of this.
Yes.
And the problem people come up with, though, is like the worry, is that inflationary, that growth?
It is. And also, Republicans thinking that they're going to grow their way out of things is pretty common. I mean, really, it would be easy to tackle the spending problem. Like we could, like Doge allegedly cut 160 billion, but we could cut 500 billion out of the budget, no problem. It's just that nobody has the will to do that.
Because you got to entitlements or reform this stuff that is politically,
it's hard.
It's really hard.
So I would prefer a mix of spending cuts and growth. But if we're just going to go with growth, I mean, look, like, even if you look at like AI capex of like 75 billion a year or something like that adds a 0.5% to GDP growth. So it could be okay.
Yeah.
That's my point.
Well, that would be radical. So do you think that a radical change, let me finish that thought, that would be a radical departure from what many are worried about, because you have sort of two camps that some people are saying that they're having some issues, tech issues, if you are watching this live. And I don't know, Rinko, you have any thoughts on that? I'm not sure why. I think I hear everything okay, and so hopefully other people do too. Maybe try to drop off and join back again. Yeah, a lot of people are having some static. Soldier on. Hopefully you can resolve it. Maybe just go audio, or live stream is not good, people are saying. Okay, well, we're going to continue. We'll see if we can work on it. And if not, maybe try audio. Anyway, apologies on that. Summertime people are updating. I just got messages that sometimes they're updating their systems. So maybe there's something going on. Anyway, I think that you have two sort of camps of people who are worried, Jared. One is that they have, they're concerned about that it is going to create all this growth, that fiscal large deficit is going to create all this growth and inflation. You're going to have rates shoot up. You're sort of emerging market type situation where you've got pressure and they're going to have all this, nobody wants the US debt, on and on that side. And then you have other people worried about these tariffs are very unprecedented. And even though we are, in the negotiation phase still, one way or the other, they're going to end up higher, and that's going to hit earnings, and it's going to hit the economy. And that they think maybe there will be a recession, and it's going to be hard because there's not a lot of wiggle room for the government to do much about that, since we spent like drunken sailors over the last few years. I think that's like broadly summing up those two camps. You're sort of in the middle, maybe thinking they can land a soft landing. It sounds like.
Well, I mean, inflation. I think the bill is inflationary. I think inflationary is going to be marginally higher. I mean, not like we had during the pandemic when we had 9% inflation, but I think there will be some inflationary pressures. And some of the tariffs are extraordinarily stupid. Like the tariff on copper is one of the dumbest things I've ever seen in my career. Trump announced a 50% tariff on copper. Like, what is the motivation for that? Because it takes 20 years to start a copper mine, right? So if the motivation is to bring copper mines back to the US, this is a 20-year process, right?
Mhm.
So really it's not about reshoring, it's about revenue collection and screwing other countries. So it's, you know, I think that the tariffs, I think small tariffs can collect revenue and be minimally disruptive. A 10% across the board tariff can collect 200 billion in revenue. But when you're talking about 50 or 100% tariffs, it causes problems. So,
Mhm. By the way, I love that you're calling it BBB. I'm going to start doing that because it's a mouthful to spit out the big beautiful bill all the time. You were so do you think the people who've been chasing stocks and who've stood in here, bought the dip, and have been continuing to ride it higher, does that seem like a reasonable thing to do here? Because you had a great riff in your note about sort of being dumb, knowing when to be dumb and be smart. But it sounds like maybe you're thinking that this is a smart move.
I can't, the stocks are hard. Like, especially if you're trading the index, not so much individual stocks, but if you're trading the index, it's one of the hardest things in the world because stocks go up on an escalator and down on an elevator, right?
Mm-hmm.
So the way I think I talked about this in one of my letters, but really it's all about optionality, right? If you are long stocks, you make 20 basis points a day for like 6 months, and then it crashes 10%, right? If you're 10%, right? So it's very analogous to buying or selling options, right? If you are a short ball trader, you like to collect a little bit of premium every day, but if there's a big move, you get blown up. And if you're a long ball trader, you will lose a little bit of premium every day, but if there's a big move, you make money. I tend to be a long volatility trader, right? Like I like to trade from the short side, not because I'm a bear, not because I'm a pessimist, not because I think we're doomed, but I just don't like picking up nickels in front of a steamroller, right? So it just makes me nervous, like being long the index, waiting for the crash.
Yeah. Do you think that's because you kind of, had a front seat to the financial crisis, or did you feel like that?
I think there's a lot of evidence that when you grow up, when you start trading, like the environment you start trading in kind of shapes your outlook on life. Like I started my career in November of 1999, right? That's when I started. Like 4 months before the top of the dot-com bubble. So I lived through that crash. And then I was at Lehman in August of 2007 when we put in the top of before the financial crisis. So in the first decade of my career, I had two 50% drawdowns, like two 50% crashes. And after you've lived through that, you just start to think that like, oh my God, like, excuse me. So
Mm-hmm. Yeah. Which, there's a fair amount of evidence that some of the, that some of the not mistakes, but some of the conditions that we now know caused that. I mean, you can look around and see that stuff. So, you can understand why you'd want to be prepared for something like that. Whether it'll repeat again is another issue. So talk to me a little bit about the Fed, because if we had a pretty good auction today, where do you see rates going? It sounds like if they can nail that soft landing, can they find a way to kind of get through this and maybe cut, but not have to do too much and sort of stay on the sideline?
I really have no short-term view on rates right now. I don't have a position in bonds at all. I can't make sense of the price action. Bonds are up a lot today. The auction was good. I will say that I think people are a little overly pessimistic about rates. They look at the legislation and they say, we're going to have these huge deficits going out to the future. We're going to have this supply. Rates are going to go higher. And I guess the only thing I would say is that people often think about the supply. So I remember in 2008, um, November, December 2008, Obama just won the election, and also into 2009. And we really started to ramp up the deficits. We had TARP, we had the Recovery Act. I think in 2009 we were running a deficit of like 1.8 trillion or something like that, which was like 12% of GDP.
We were throwing everything at that thing.
Yeah. So I was sitting in my office and I'm like, there's no way that the market can absorb this supply. Like, we are going to have a failed auction. Like, the bond market is going to crash. And lo and behold, not only did people show up for the auctions, but they were some of the best auctions we ever had. Mm-hmm. Like, people wanted U.S. debt. I mean, you're talking about like bid to cover ratios of like 3.5 on those auctions. So inside, like, we almost have the highest interest rates in the world. The UK is about 10 basis points higher. But if you're looking at, like, we have bonds at 5%, 4.9, it's kind of tough to get 5% relatively risk-free anywhere in the world. So if you get rates out to 5.5%, there's going to be even more demand, right? So I don't think, like, the scenario, there's a lot of people on Wall Street who think the bond market is going to crash, rates are going to just go parabolic. Like, I don't think that happens. Like, there is demand for bonds at successively higher interest rates.
I think this is really interesting, because what you hear is that they, back in 2009, I mean, the wheels were coming off the financial world, the financial system. And so there was a safe haven rush for anything that looked rock solid. The argument these days is that the U.S. treasuries are not the safe haven they were before. And people don't want to be holding them. They don't want to hold dollar assets because it's been weaponized in what is now sort of, whether you call it, economic warfare or economic war or nation state craft, or, all these terms that are being thrown around. And that it's different now. And certainly parts of the world don't want to hold them, but maybe the Europeans and maybe some other people are thinking about repatriating their money back home. And there goes the demand for both treasuries and maybe stocks. You think that's overstated?
Oh, I totally do. First of all, I'm bullish on the dollar in the short term. Long term, maybe bearish, but in the short term, I'm bullish. Like, the narrative changes over time. Like, this is the prevailing narrative right now. Like, get out of anything that's denominated in dollars. Like, the dollar is doomed, and repatriating all the stuff that you talked about. But the narrative changes. Like, we could have some headline event, something tomorrow. There could be a geopolitical flare-up somewhere in the world. Like, we are a really, really long way away from the dollar losing its reserve currency status. Like, the dollar is so prevalent in international trade. Like, we just can't do without it. So I'm bullish on the dollar in the short term. And I just think this narrative is a little out over its skis. So.
Yeah, that's so interesting. By the way, I think you're the third person that said this on this show. All of those contrary to what the broader, macro universe certainly, and a lot of pundits are saying. But it started with Dale back last Monday saying it looks like it's due for a bounce. There's just no one left to sell anymore. It just looks overextended, this big move that we had. So you're in some good company there. So J&J asking, how does the dollar value affect demand for U.S. debt? If Dixie keeps going down, would people still buy treasuries?
I mean, the answer is yes. I think so. I have support in the dollar index at around 96.30. That's where I think support is. It's around 97.5 right now. I think it goes up to anywhere between 99 and 102 in the short term. So I think we're going to have a pretty big move in Italy, and that's just based on technicals. Like, that's just based on my technical work. I agree with Dale. Like, I don't know Dale Pinkert super well. I was on his podcast during the pandemic, and he's super nice guy, and I see him on Twitter, and I respect his work, and I think we're on the same page on
Yeah,
that.
that was exactly, he was going to buy, his line was 96. I don't know what his resistance was, but he's a real chart, as a lot of those old flooring commodity people work with a lot of experience. They kind of look at charts differently. And so they're really attuned to changes. So that you're both in lockstep with that call. And Dale grades his calls from appearance to appearance, and he'll fling me some emails when it's going right or wrong, and take responsibility. So I just tweeted that out because he mentioned that. So Jim has a really interesting question. Jim K. Why buy treasuries when investment grade corporates are paying better yields?
Well, I mean, corporates always pay a better yield, but spreads are there's a lot of interesting things going on in corporates, particularly high yield. Like high yield has become higher quality over the last few years, and part of this is because the really sketchy credits are in private credit, and part of this is because really a lot of high yield issuers have improved their balance sheets.
Mm.
And so you've actually seen some ratings upgrades in the high yield universe. So when you look at HYG, like it's actually a better quality credit than it was 5 years ago. So I'm not like I think ultimately, if you want to talk about private equity, we can talk about that. I think private equity imploding is going to be the catalyst for spread widening and credit.
Mm.
Whenever that happens, I'm not super excited about buying credit here. You get spreads out to like 550, 600. I would be excited, but it's a little too tight right now.
Yeah.
So
one of the things that you were doing, yeah, sorry, we're getting lots of comments. We don't know what's going on. It's from one of the platforms. It's not for us. There's nothing we can do to adjust it. I'm sorry, folks. One of the, I'm wondering how you're feeling, because I know when we've talked in the past, you're really interested in looking at the rest of the world, but you look for value. You know, you were talking about Argentina before anybody was looking at it. So this is not new for you. But how are you feeling about that rest of the world versus the US? It's outperformed this year. A lot of people believe that we're on this sort of decade-long kind of rebalancing, not totally selling the US, just increasing exposure to all these other parts of the world that are going to be upping their fiscal spend and look like they have maybe more fiscal tailwinds behind them. How are you feeling about that rest of the world versus US?
I mean,
position.
That's probably my number one idea over the next 5 years. And I think the dollar weakness has really kicked it off. The last I looked, Europe was up about 9% on the year, and the US was up about 3%. Emerging markets have been doing very well. I saw a headline on Bloomberg the other day that there's been a lot of flows into EM lately. I think people are rediscovering. I mean, me personally, in terms of my equity portfolio, I am 90% overseas and 10% in US.
Wow.
The valuations are better, much bigger dividends. You want to go looking for dividends. It's not hard to find 6 or 8% dividend yields on countries. I mean, this is, and a lot of it is value investing. Like if you're a value investor, you look for cheap valuations and big dividends. So, yeah, that trade, U.S. versus the rest of the world, trade, I don't think has even really started yet. I mean, this is like the top of the first inning. And I was around for the last time international equities got really bid up, which was 2004, 5, 6, 7, somewhere around there. I mean, that was when the dollar was very weak. I mean, the flows into international stocks back then were just enormous. So that could totally happen again. So,
and Jim is reading my mind. Where overseas does JD like? Europe, LATAM? Do you have a region that we know? Buffett was big in Japan, of course. You know, that was before we all found out about it. So, is there a region that you like more than others?
I don't like Japan. Japan is overvalued. I like Latin America a lot. Latin America and Europe mostly, I would say.
And do you do equities? Are you looking at bonds there too?
Just looking at equities. Yeah.
Interesting. Do you think about I noticed when I was going through, because this comes up often, and I was just going through some of the different international ETFs and what's popular and what people are looking at. Does it matter to you if they're local currency or their currency hedge? Because you have them across the board. Is that an issue for you? Is that something that you?
Well, I mean, so I mentioned earlier that I'm short-term bullish on the dollar, but I'm long-term bearish, right? Long term, I'm, in terms of 1 to 3 years, I'm super bearish on the dollar. So you want stuff in local currency. There's actually a super interesting ETF called EMLC, which it's a Van Eck ETF. It's called it's Emerging Markets Local Currency Debt. So you can buy EM bonds issued in local currency, which is super sketchy because talking about places in the world with really sketchy local currencies, but it's actually doing pretty well. It's doing pretty well, and it pays about 6-7%. And that's the type of stuff I like to look at.
Yeah, super interesting. I mean, you might not want to pile into it, but certainly something that you can play around with and see how you feel and track as we see these things change. Christopher earlier, welcome back, Christopher. He's been out of the chat for a little while, but he was asking, why were banks like JP Morgan so weak yesterday and no balance today? Is there a story brewing?
Oh, I have no idea. I didn't even notice that.
Yeah, he might have been asking the chat too, not specifically you, but that is sort of interesting. By the way, you mentioned private credit before, Jared. Supposedly, one of the most read stories in the Bloomberg today was about how Goldman Sachs is asking their new hires to swear they're not going to get poached by private credit, because evidently private equity firms rather come in and just as they're getting hired, say in 2 years, like give them an offer 2 years out. And so it's kind of been this rotating door. But I thought that was so interesting because private equity, private credit, all these deals where all that money went, a lot of people are worried about something kind of blowing up in one of those areas. And maybe a lot of these investments they made are underwater.
Yeah.
You mentioned it before. See trouble there?
That's been sort of the job pipeline for younger kids on Wall Street is you do 2 years at the bank and then you move to private equity.
Yeah.
And the banks are, having a shortage of mid-level bankers because all these guys and girls go to private equity. I don't look, my views on private equity. It's funny that Goldman would do that. I did see that article, but I don't think that's going to be an issue a couple years.
Right. Just if there's got to be some layoffs coming in that area, right?
Yeah.
I felt like that was one of those magazine cover type things.
Yes.
If you're worried about that, we're probably like right at the tipping point where we start to have layoffs in private equity. Any areas that sentiment seems too stretched for you? Another question.
Really just FX. Dollar is too cheap. Everybody's bearish on the dollar, but for somebody who looks at sentiment all the time, I said in the beginning of the show that I'm bored. There's really nothing is really outside of FX. Nothing is really trading at extreme levels. Nothing is getting me interested here. Yeah. Nothing in commodities, nothing in rates. Just really FX. And I'm not super interested in shorting stocks here either.
But you still like gold, right?
Yeah, and gold is, the nice thing about gold is people are forgetting about it. It's in the middle of a 4-month consolidation. It hasn't done much in the last couple of months. It's actually been pretty resilient. We'll see if the dollar rallies. We'll see what happens to gold. If the dollar rallies a couple percent, you might see gold go down to 3,200 or 3,100. But ultimately, I think this consolidation resolves to the upside.
Good stuff. So, just want to close out and ask you about the book. So, wait, you're in the middle of a book tour. You're having a book signing, a book party in Nashville. What's going on?
So, I have a book signing tomorrow in Myrtle Beach, and then next week in Nashville. I have a book signing on July 17th, and then I am DJing at a club called Night We Met. It's sold out, it's totally full, and I'm really looking forward to that. And then I have another book signing in New York in August. And then, yeah, I have another DJ gig in Vegas on July.
I know I was going to say you're DJing in Nashville, hot off your Vegas. This is a book signing and a DJ gig in one night must be like for you, Jared. That's like heaven.
Well, I mean, I'm going to enjoy it. It's going to be a lot of fun. Like, the nice thing is that most of the planning is already done, so I don't really have to
Just
worry
enjoy
about
it.
I can just focus on it.
So is there a rule 762 rather? What is rule 62?
Rule 62 means don't take yourself so damn seriously. That's what Rule 62 is. And if you actually, so Rule 62 is one of the essays in the book, and if you read that essay, you will actually read about how I went on a competitor podcast to you, and the people on the podcast took themselves really, really seriously. And we can talk offline about who that was.
And that was the
was the
inspiration, the spark for that particular essay. It's so interesting to me because I mean, you know, this is what, your fifth, sixth, seventh book?
Sixth book.
No, fifth. Sixth book. Which is amazing that you're able to write them. You teach creative writing out of college. You're DJing. There's this enormous, I mean, I love this side that you find time for, make time for, this sort of super creative side on the other side of investing. That's such an interesting juxtaposition. Does one help the other, do you think?
Well, I mean, it definitely helps to take my mind off of markets for a little bit. Otherwise I would just be obsessing about my positions in my portfolio and stuff like that. I mean, really, I have a philosophy about this. I should probably write a piece about it. Money management, managing a portfolio shouldn't take a lot of time, right? And I think that there's this view that unless you're putting in 20-hour days, like you are, I guess, underserving your investors. You know what I mean? Like, you have to be digging through K's and Q's. You have to be reading research. You have to do all this work. And like, there's just not enough time in the day to do all this work. I don't think that's the case at all. Like, really what investing is about is making decisions, right? And it takes a second to make a decision, right? And it really, the best decisions are on incomplete information. If you have complete information, it's too much information, right? You can't analyze it all. So I have a completely different investing style than some people. I like, you know, it doesn't take me a lot of time. So I have time to do other stuff. I can, you know, play music and teach and write.
Yeah. Sometimes I find that other stuff, I mean, when I do something else or get out and talk to people, it often for me, you know, sparks tons of ideas, or it gets me great feedback or observations about things that are happening in the world, which at the end of the day, investments are a reflection of somehow. You know, there are technicals and all of that, but, you know, somehow it's a reflection of the world. So I feel like sometimes that's great inspiration and gives you a fresh perspective coming into that. What's been the most fun about doing the book tours?
Well, first of all, you know, I just want to talk about the book. So this is a collection of 79 essays on success and spirituality. And really, the genesis of this was, you know, Maggie, you and I didn't know each other 20 years ago, but if you knew me 20 years ago, I was a complete disaster. I was a disaster. Like, emotionally, I was a wreck. I had OCD. I had all these psychological problems. Like I wouldn't speak. Like, I was really quiet. Like, I was a mess. And really, you know, getting to where I am today has been a 20-year process of working on myself. And, you know, I like to share that wisdom with other people. So this is, I highly recommend picking up this book. Also makes a great gift. I would say pick up 5 or 10, give them out for Christmas. It's a great gift to people. It's PG-13. There's some F-bombs in there, but it's not
the kids haven't heard before. Listen, I think it's really important because, dare I say, especially for young men, because we hear about this epidemic of loneliness, of people not feeling well, not thriving, not getting out there, not sort of forming their lives. It's been really hard. I think it's been hard on the younger generation. A lot of people just feel more isolated. So I think it's really generous of you to share your thoughts, and give people some hope on the other side of what can be a really hard time and a struggle. So I think it's wonderful you do that, Jared. Really,
Thank
the
you.
service. So we know where it is. It's on Amazon. Go check it out. Come to the book signing. I know some of us are gonna do our darndest to make the one in August. It's gonna be a lot of fun. I always try to make Jared's gigs, but I'm such an early riser, and one of these days I'm gonna make it when it's early enough. But it's gonna be a lot of fun. So we look forward to doing it. By the way, Paul said, Jared, your Coast Guard bros did a hell of a job down here in Kerr County, Texas, the past few days.
Oh yeah, I mean, there's that story about the they're called ASTs, Aviation Survival Technicians. Those are the guys that jump out of helicopters. There's a third-class petty officer who saved 165 people. He's going to get the Coast Guard medal. Like he's going to get a hero medal out of that.
He training, I think, too. He's brand new. He just came out of training, and to be put to that test in that sort of extreme circumstance is extraordinary. Thank you for calling that out, Paul. We've all been watching it. For those of you, most of you probably know Jared was in the Coast Guard. Jared has a really interesting backstory. We've talked about it before on podcasts, but it's threaded through all his books and essays. When he says he's sharing his learnings, a really hard one and great. It's a great read and really extraordinary. It's some of the stuff you've been through that Coast Guard. I'm not sure everybody would have put that. We should have had a quiz on that.
No, the funny thing is, I can't swim.
That's uncommon.
I was in remedial swimming at the academy.
No.
I had to, basically you have to swim, I think 100 or 200 yards to graduate in a certain amount of time. And I just barely did it. Like the joke in the Coast Guard is that you only have to get from the ship to the life raft. Like that's all you have to swim is to get the ship to the life raft.
It seems like certainly a vulnerability, but thank goodness that some of the guys down in Texas could swim a lot better than that. But really great stuff. Well, congrats again on the book, Jared. I can't wait to dig into it. And if you love it, leave a review for it too. Always great to catch up with you, Jared. Thank you so much.
Thank you.
We'll see everybody soon. Coming up, folks, and again, sorry if you have to watch this on replay, if it was a little bit, hopefully they get their tech gremlins out of the way. Coming up, Vincent Delard's with us on Monday. He's got a really interesting theory that has a lot to do with currencies and the rest of the world. I think it's going to be kind of provocative. So I'm excited to have that convo with him. So we'll see you then. We've got a Friday release coming too, another big macro conversation. I think it's going to be really interesting. We'll send out some info on that. And as always, email us with thoughts of people you want to see. Send us an email or drop it in the comments. We read them all. Thanks to everybody. Have a wonderful rest of your Wednesday. Take care and good luck out there.